So, what if all this wild volatility we're seeing in silver, what if it isn't just noise? Today, we're going to unpack a really compelling thesis that argues it's actually the first tremor of a much, much larger event. We're talking about a potential credibility crisis in the global bond market. Let's follow the dominoes and see where they lead. Right off the bat, you need to understand this isn't about some normal market rally. The core idea here is a sudden system-altering shock, a move that's so fast and so final, it feels like a heavy door slamming shut, catching almost everyone on the wrong side. All right, so how could this whole chain reaction play out? Well, we're going to start with the unique warning signs that are supposedly flashing in the silver market. Then we'll get to the much bigger threat, the one lurking in government bonds. After that, we'll look at how policymakers are expected to respond. And finally, the explosive four-phase shock that it could all build up to. Okay, let's look at that first domino, silver itself. The thesis here argues that the metal is showing a very specific pattern, a kind of market signature, that in the past has been a major tell, a prelude to some absolutely explosive moves. The key concept we need to get is something the source calls time compression. You see, instead of those long, drawn-out corrections, the dips just get bought up faster and faster. Pauses in the market that used to take weeks now take days, and then maybe just hours. It's like coiling a spring tighter and tighter. All that pressure is building up for a massive release. And honestly, this is a great way to think about the relationship here. Gold is like the quiet, respected grandparent in the precious metals family. It's slow, it's steady, but silver? Silver is the volatile, energetic younger sibling. So when that younger sibling suddenly starts out running the grandparent, it's a huge signal that the market's entire mood is changing. And that brings us to this crucial number, the gold to silver ratio. It's pretty simple, it's just how many ounces of silver it takes to buy 1 ounce of gold. The argument is that when this ratio starts dropping fast, especially towards a key psychological level like 50-1, it means silver isn't just tagging along anymore. It's actually starting to lead the charge. And this really shows you why silver is so unique. You know, it's not just money. A huge chunk of its demand, we're talking about half of it, is industrial. The solar sector alone has become a massive, massive consumer. And this demand isn't just some fad. It's a structural force that props up the market totally separate from what investors are doing. All right, so let's move to that second domino, because this is where things get serious. The thesis claims that silver's behavior is really just a symptom. The true cause, the real catalyst for this whole chain reaction, is a deep and growing stress in the government bond market. You know, we tend to ignore bonds, because, let's face it, they can seem kind of boring. But the source describes the bond market as the spine of the entire financial system. It's everything. It's how governments fund themselves. It's what banks use for safe collateral. It's what our pension funds are built on. So if that spine starts to wobble, the entire body is in trouble. And there are some pretty clear signs that the spine is wobbling. We're seeing long-term government yields jump around in major economies all over the world. The US, the UK, Japan. These aren't just little isolated incidents. These are signs of a systemic strain that is reportedly making officials very, very nervous. And this is the critical point. The threat isn't a normal market crash. The source argues it's a credibility event. That's when investors stop worrying just about the price of the debt and start worrying about the promise behind it. It's a fundamental breakdown of trust in the system itself. And just to put this into perspective, the source points to the sheer scale of the problem, a nearly $2 trillion deficit for the US in a single year. The interest payments alone are becoming what's called a monster line item. I mean, that's the kind of pressure that's building right at the very core of the system. So if the bond market really does face a crisis of confidence, how do you think policymakers are going to respond? Well, that brings us to the third domino, the predicted and maybe inevitable official reaction. So the core argument is this. When governments get cornered, they're not going to choose the painful path of cutting spending, of austerity. No way. They're going to choose the path of least resistance, and that path is liquidity. And let's be honest, liquidity is just a nice-sounding word for creating more money to paper over the problems in the debt market. This right here is maybe the most important idea in this entire thesis. The source uses this fantastic analogy. Creating all that new money doesn't actually make your assets more valuable. What it does is it makes the currency you use to measure them, your measuring stick, worth less. It shrinks the measuring stick. And that single action sends a powerful message to the entire market. paper promises are becoming less and less reliable. So what happens? It forces investors to run for cover, to seek refuge in tangible assets, things you can actually hold, things that can't be printed out of thin air, things with no counterparty risk, like precious metals. They get repriced not because they changed, but because the money itself changed. Okay, so what would this actually look like in the real world? If all those previous dominoes fall, the thesis predicts a very specific multi-stage shock. It's like the anatomy of a massive breakout. Now, of course, these are the numbers that really grab your attention, but it is so important to understand these are conditional projections. The idea is that if a crisis sends gold absolutely soaring towards, say, $7,000 or $8,000, and if that historical ratio to silver tightens up, then silver could mathematically land in a price range that sounds completely insane right now. But, and this is critical, the path there is not a straight line up. The source lays out this whole psychological journey. First, there's a slow grind higher that most people dismiss as a bubble. Then, boom, a catalyst sparks a sudden acceleration. And then, crucially, comes a violent midpoint stumble, a brutal, terrifying shakeout designed to scare everyone out. That's followed by the final, almost vertical blow-off phase as the public finally stampedes into the top right before the eventual aftermath. And so this all leaves us with the one central question. This thesis frames what's happening today not as the end of the story, but as a potential beginning. The pressures are building, the dominoes are lined up. So the question for you is, are we watching that very first domino start to wobble, or is this just a minor tremor before the real event kicks off?